Advanced Financial Modeling, Topic 9, Forecasting Financial Statements, Free Cash Flows, and Stock Valuation. Learning Objective Number 2. We're going to evaluate external funds needed and capital structure, or in other words, financing decisions. So we finished the last topic by forecasting our first pass to our financial statement, making these assumptions on balance sheet and income statement. And when I did that, I wound up forecasting that I'm going to have an extra $153.36 of external funds needed because my assets exceed L&E by $153.36. So what we're going to do in this one is talk about different ways of trying to balance the balance sheet or come up with those funds to buy the assets needed. We're going to look at 100% equity financing, maybe eliminate the dividend, then do 100% equity financing, maybe do all debt financing, and maybe talk about a mixed strategy. Also, as we do this, we're going to see the effect of this strategy on the ROE. So let's go to our spreadsheet. Again, here's the difference between L and E and assets, 153. One easy way to get rid of that is just issue $153.36 of stock. If I do that, the balance sheet's automatically balanced because that 153, I have it in the calculation here. My common stock goes 375 shares to 528. I get that extra $153, and that'll be used to buy these assets that are needed to then drive these sales numbers. You can see how that affects the shares outstanding in the company, assuming this company has a $15 stock, and I issue 153 shares. $153 of stock at $15 a share. I issue about 10 shares, so the number of shares is going to go up. The earnings per share is going to go up. That's because of the higher profit numbers. However, look what happens to ROEs. ROEs are going to go from 13% to 12%. One way of thinking about the ROE using our DuPont analysis is you can think of ROE as asset turnover times equity multiplier times profit margin. All right, so you can think about this as how good are you at turning assets into sales, how good are you turning sales into profits, and then equity is how good are you at turning equity into assets by using debt. And you can see when you multiply those three together, my ROE is going from 13 to 12, a little down. And why? Well, my asset turnover is exactly the same. My profit margin actually went up a little bit. What's happening by issuing equity is I'm de-levering the firm. I'm using more and more equity financing instead of debt financing, and that's lowering my return on equity. I had been using a mix of debt and equity. However, this decision is using only equity. Another thing you could do is I could maybe eliminate the dividend. Let's take the dividend to 0. Now I only need 121.15, and I can just issue stock of 121.15, and that solves the problem. Things look about the same. However, stock markets don't usually react too kindly on eliminating the dividend. Sometimes they consider that as a kind of a clue that the financial future of the company is in jeopardy if they cancel their dividend. So I'm probably not going to do that. So I'm going to undo those two changes. The other thing I could do is I could issue more bank loans or debt. What if I take that 153.36 and issue new debt? So notice here, the debt goes from 400 to 553. That's the 153. However, I didn't balance the balance sheet. So this is the end of the second pass. All those scenarios we just did was the end of the second pass. However, those other scenarios, this balance sheet was balanced. I had no EFN, because when you use equity or dividends to balance the balance sheet, it has no effect on interest, and therefore the balance sheet is balanced by simply adding those balances to common stock or reducing the dividend. However, when I add $153 of debt, that is going to create more interest expense. And when that interest expense goes up, that means my net income goes down, which means my retained earnings goes down, which means my L&E goes down. So there's this feedback effect by using debt that's going to increase interest, reduce net income, reduce L&E through retained earnings. So I didn't balance the balance sheet. So at the end of this second pass, I still need 690. So what I can do is I can just issue another 690. So I'll go in here, change this formula to equals 153.36 plus another 690. All right, when I do that, I'm pretty close, but that 690 increased my interest and so on. So what I need to do is add another 41 cents. This is the fourth step, fourth pass. I'm still 2 cents off, so I'll add another 2 cents. So it's this iterative process where you keep adding to the debt balances to finance the shortfalls in retained earnings driven by interest. So this could be a way, if you want to finance 153 shortcoming in EFN, I actually wind up having to issue 160.59 in debt because of the interest. But that is a solution. You could also have a mixed solution. So a mixed solution would be to maybe issue equal amounts of debt and stock. So I got 153.36. I could do, say, equals 153.36 times 1/2. So I can issue $76 of debt and $76 of common stock. I still didn't balance the balance sheet. I still have EFN of 345 because of the debt. I could then finance half of that 0.5 of the 345. I'll copy that 1/2 times 345. And I could do that also with the stock balance. But I'm still 8 cents off. So I can add another 1/2 times 8 cents in debt and 1/2 times 8 cents in stock. And the balance sheet now balances. When I use this mix of debt and equity, I'm still delevering a little bit, meaning that I must have used a little bit more than 50-50 of debt and equity in the past. But it's still, I'm now a little bit closer. The ROEs are not that affected. All right, so there we go. That's using different ways of financing the EFN, the external funds needed, using mixes of debt and equity. All right, so let's talk about this process in general. In the prior example, the management had a positive EFN, in other words, assets were greater than L&E, and they could solve that problem by paying a smaller dividend, issuing stock, which increases L&E, increasing debt or bank loans, which increases L&E. They could have paid down their cash balance if cash wasn't needed to just run the business, or I could have bought less fixed assets. But that's a can of worms. If I buy less fixed assets, I need to then think about reducing sales, because now I don't have the same production capacity and delivery vans and all those things you need to produce sales. And so that's going to cause a whole feedback. So I didn't want to touch that one. If, however, what if the EFN was negative? So let's go back here to our model, and I'll just put in a 0 here, 0 here. What if we only forecasted that sales growth was going to be 0? Well, in that case, I'd actually have a negative EFN. I have forecasted assets of 1350 and L&E, the financing, of 1427. I have extra money. If I had that situation, well, that's a better situation to have. I could pay a larger dividend. That's going to reduce my L&E. I could repurchase stock, reduce stock. That's going to reduce my L&E. I could pay down debt. That's going to reduce my L&E, but then I'm going to have that feedback mechanism where I have to do that several times. I could increase my cash balance. I have extra, I could just hold additional assets as cash. That's going to also cause some problems and a feedback, meaning that I'm going to also generate some interest on that. Or I could buy more fixed assets, build another factory, buy more delivery vans, things like that. But then that's also going to have that feedback on sales. I'm probably going to increase my sales numbers, which then increases in fixed assets and so on. So it's going to keep going and going. So I'm not going to play with that one for now. All right, so that is my EFN and pro forma financial statements and forecasting them. This whole process of determining what is my sales growth, how am I going to finance it, is my factory big enough to support that sales growth, and what are those fixed assets going to need to be, and so this is a financial decision, but it's being done at the highest level. It's a decision or set of decisions to make to decide the future of the organization, or how fast you're going to grow, what assets you're going to need, what returns you're going to give back to your shareholder, the number one metric being, say, ROE, return on equity. In the next topic, we'll talk about assessing growth and EFN a little bit more.